Hi everyone, a very good afternoon. You're watching the newsroom on ET now. I'm Mubina Kapasi. We have the markets that are making an attempt to sort of rebound from the low point of the day. And you know, remember, it's also, of course, expiry week. So perhaps one can expect a fair bit of sort of volatility this week. But if the yellow metal is something that you want to add to your financial portfolio but don't want to go through the hassle of buying physical jewelry, then gold ETFs is something that you should consider. On Nivesh Ke Fande, we take a look at gold ETFs.
Welcome to this edition of Nivesh Ke Fande, where we are talking about one of India's favorite asset classes, gold.
That's right, Mubina. India loves the yellow metal and it serves as a good hedge against inflation as well as volatility in the equity markets, which is something that we've seen pretty often over time.
And speaking of time, gold is one of those asset classes that has actually evolved and adapted with time.
Yes, if an investor wants to add gold to their portfolio, they don't need to invest in physical gold. They can buy gold ETFs.
That's right. A gold ETF, or a gold exchange traded fund, is a commodity mutual fund that invests all its money in gold, and the units can be bought or redeemed on the exchange just like an exchange traded fund.
And the benefits of investing in gold ETFs are many, starting with the fact that the investor does not need to worry about the purity of gold or even the making charges.
Yes, because there's no physical gold that one has to buy or sell. And this also gives peace of mind because the units are lying in demat form and not lying in one's home.
And because gold ETFs are freely traded on the exchanges, they capture the real-time market movement of the asset class and provide easy liquidity to the investor.
So if you're looking at some gold to wear, then buy some beautiful jewelry. But if you're looking at gold to invest in, then consider gold ETFs. That's all on this edition of Nivesh Ke Fande.
All right, well, let's take a look at some of the big movers and shakers in our Market Fatafat segment. First up, we've got to start off with, the Nbfc category, Equitas, IBFC, all of them are seeing this massive rally build up on, on the long segment as well of all of these stocks. And this, of course, has to do with the announcement that came in. These are just right now recommendations and proposals, nothing more than that. But this essentially pertains to the ownership and corporate structure of private sector banks. So we have Equitas, IDFC firing up in trade. In fact, even an IndusInd Bank, Ujjivan, IDFC first two are showing some very, very sharp gains. The other big news maker is AstraZeneca. In fact, the news has just hit our screens about an hour ago, and that's positive news coming in. AstraZeneca has said that its coronavirus vaccine is around 90% effective. It is being developed, of course, along with the University of Oxford, and 90% efficacy is really not bad. This is, of course, they've also saying that they've got 100 million doses on order, and a bulk of the rollout should be done on the new year. So optimism around, and look at the spike as well in an AstraZeneca stock price today in trade, massive one being witnessed. Okay, moving on, take a look at what's up with the stock price of RIL. The last week saw the stock actually take quite a tumble. In fact, my colleague Jayesh as well told you about the underperformance of RIL versus the markets. Today, finally, we are seeing quite a bit of green on the screen, 3% of gains. This, of course, after that CCI nod. Workhard continues to rally, a very smart move being witnessed. Wonder what the trigger is over here, but double-digit gains today as well in trade. And then Motherson Sumi, we've been on top of this story. We told you about the 5-year plan, and you just heard out the management as well of the company speaking on the same. And like I mentioned, speaking on the entire RBI panel proposal, a big overhaul of the banking sector may be underway. The RBI's internal working group has recommended that corporates be allowed as promoters of banks. So NBFCs, microfinance institutions, even banks, in fact, are seeing a major rally on these proposals. Large corporate becoming promoters of banks. They are encouraging more players as well to eye a banking license. Uniform cap on non-promoter holding by any entity at 15%. 10%. These are just some of the highlights. Now, moving away from banking and financial to autos, looks like the wait for a scrappage policy will continue for the next few months, with ET now learning that the policy that will incentivize new car purchases is likely to be unveiled in the next budget. That's in Feb 2021. Utkarsh joins us with more details.
We've been waiting for the scrappage policy for a very long time. It seems like now we'll have to wait till the budget at least. Given the fact that the policy has taken so much time to really being rolled out, despite several assurances from the ministry as well as other sections of the government as well, we shy away from saying that surely it is coming in the budget, but that is what we have been told by our sources in the ministry. And what they're telling us is that in Feb, in budget allocation itself, they'll be giving a separate allocation for scrappage policy. Why do you need money for scrappage policy? Is because you need to incentivize somebody to scrap their old vehicle and is buying new one. Now, Motown has already gone ahead and said that we will be giving you a 1% discount on a new vehicle which will be bought post you have really scrapped your old vehicle. And now it's the turn of the government to really go ahead and incentivize. What are the ways to incentivize? The biggest one everybody's talking about is cut taxes, and that is what the government is also looking at. But given the current situation they're in, they're still in talks of how much relaxation in taxes, how much incentives needs to be given to somebody who scrapped their own vehicle and is buying their own. But the way it looks like, the money will be allotted in the budget, and it will be a budget announcement coming in Feb when it comes to the scrappage policy.
Exactly. All right, Utkarsh, thank you for that. Well, moving on, the Delhi High Court will today decide if ever-ready promoters can be allowed to sell assets and shares, which investor KKR has, by the way, objected to, because KKR India wanted to extend the stay on the alienation of assets by ever-ready and other subsidiaries of its parent company, Williamson McGaw, till the final arbitration award is decided. Abhimanyu Sharma joins in for more details.
Fate of various Williamson Magar Group companies hangs in balance as petitions by McNally Bharat, Everready and McLeod Russell will be decided today by the Delhi High Court. The court will pronounce its verdict on whether Everready and other group companies of the Williamson Magar Group can sell assets even if the investor KKR India is opposing the sale of assets. In December 2019, the Delhi High Court had restrained Everready and other group companies to not sell assets till the case is pending, which means that KKR India had sought that till the arbitration remains pending, any sale of assets should not be allowed, something which has been opposed by Williamson Magar Group companies. KKR India had sought to extend the stay on asset sale till the pendency of case. They had claimed that the Williamson Magar Group companies were intricately related and cannot be considered detached from the case. They had referred to several secret documents to establish that Williamson Magar Group companies cannot wriggle out of liability. On the other hand, Everready and other Williamson Magar Group companies had submitted before the High Court that the group entity doctrine cannot be invoked in this particular case, and having the same parent company does not make them liable. They had submitted that the parent company cannot be made liable for loans taken by subsidiaries and vice versa.
Thanks for that. We'll take a very short break on the show. Don't go anywhere.